The broadcast is now starting. All attendees are in listen-only mode.
Good morning and welcome to the CW Research webinar on our global cement volume forecast for the first half of 2018 and beyond. So today wanted to share a couple of highlights with you from the research team on our upcoming benchmark report release, which is the first half of 2018, which has our 5-year projections for global cement volumes around the world for key markets and key metrics for these markets. Today, I will be presenting a couple of slides, including introduction to who we are, some macroeconomic perspectives. I'm Robert Madeira, I'm the Managing Director and Head of Research for the CW Group. Together with me, I will have Tia Vukasevich, who will be presenting a little bit on the cement markets. She's the lead analyst on this report, and she will be sharing some of the perspectives together with one of our analysts, Felipe Gouveia. They will be taking over the second half of this presentation. So today, first of all, I want to give you a little bit of an introduction to who we are as a group. And tell you a little bit about the different capabilities that we offer as a team. We're a group of seasoned experts that are very familiar with the cement industry and other industrial segments, and we are well entrenched in global sector and industry. And in our analysis, we don't only do sort of the quantitative analyses and perspectives of the markets, but we're very engaged with professionals around the world to draw on primary research and really sort of that frontline experience in shaping our analysis and recommendations. This is something that we do, of course, for those that know us in the cement and building materials sector, but we also do that for other sectors like steel, chemicals, dry bulk, power, energy, and other related sectors that sort of go along with that and both support the cement sector as well as our important standalone segments. Within our advisory function, we provide consulting services, both strategic advisory, M&A, due diligence, transaction support, feasibility studies, optimizations, and all sorts of other analysis that go along with creating a better, stronger, more competitive business. That's in sort of parallel to our research function, which is sort of what we're presenting here, which is our team that's tasked with producing reports on key market topics, forecasts, price assessments, and other different perspectives on the markets in report format and different key studies covering cement and other segments such as equipment, lime, and many other markets beyond cement. And of course, we have our market reporting and media team that is responsible for providing coverage of the global markets, providing key updates as to what's happening around the world from a news perspective, from a different aspects that are important for us to know how the competitive markets are shaping up and what that market intelligence can tell us in terms of then inputs for other research and on analysis. We also host our own meetings. We have CW summits, which we do around the world. And this year, later in the year, we'll have one coming up for EMENA, so Europe, North Africa, and Middle East. It will be hosted in Europe together with our GMI global colleagues that will be organizing that meeting. So keep an eye out for that. A great opportunity to meet analysts, discuss strategic perspectives, trade, pricing, assessment from our assessments, and other important aspects that shape the cement industry. So now that we've talked a little bit about who we are as a cement team and who we are as the CW Group, wanted to give you a little bit of a perspective on what the report is that we are highlighting today. So this is the global volume forecast report for cement, and we have this essentially 2 times per year. We had this in March and in October. And the first half of 2018 is what we call our quantitative update, which is more of a revision of our outlook for 57 national cement markets, where we take into account the latest updates in the markets that sort of both from a macroeconomic perspective as well as national, as well as, of course, cement sector-specific information where we revised then the outlook for the next 5 years. And then in October, we have a more extended version where we provide more of a perspective for each of these markets. And we're going into more detail to fundamentally sort of explain the different drivers in the markets that sort of around the world. So you subscribers to this report get both these issues. And in these reports, we provide a 5-year perspective of the markets. And what we've introduced this time is a long-term forecast as well, with our views on how the cement volumes will shape up sort of by 2050. So that's an interesting new addition to the report, but we thought that was an important perspective to provide a little bit longer range view on sort of a what-if basis the world might look like in sort of 30 plus years. We're not going to talk about that too much today, actually, as we have a separate and upcoming webinar to cover that topic in more detail. But this is really an interesting thought experiment that we've put in a lot of time and effort into sort of shaping up and think about what may drive those changes. But it is included in this first half of 2018 report. We welcome any feedback on that particular topic, because that is more of a discussion topic, a point of departure for ideation than a conclusion. Then sort of if we just look at the report a little bit closer, what is it that we include? The national cement consumption. These are in tonnage basis, per capita, production, utilization rates, and also capacity for the countries, and of course import and sort of net trade numbers for each market to be able to assess both the supply and demand equation properly. We included 57 markets that I talked about, and you can find out more information about this on our website that sort of is linked here. For this revision, we've made a couple of updates that are worth highlighting. We included 2 new countries, Kazakhstan and Taiwan. Important markets, different markets, but we felt that these were important additions to include, given their Taiwan particularly, its size in the global cement world in terms of tonnages. And this is something that we do. We look always at the report and we ask ourselves what needs to be updated and what needs to be included, as we sort of always try to keep the information fresh and as relevant as possible. So, as I also mentioned, we have the long-term forecast, and we also have a perspective looking at how the companies performed in the last year from a volume perspective. So look at key companies there. And we're sort of linking the companies with the market perspective and providing some interesting observations around that part. We revised a set of capacities, as we always do, and these are both sort of historical and forward-looking, as we always keep fine-tuning what those capacities are. There's no shame in revising, it's shame in maintaining something that you don't really believe fully in. So as we incorporate, as we discover new information, we keep incorporating and obtain feedback. We incorporate that into our forecasts and data series to make sure that we always keep refining and tweaking everything that we have. So these are some of the major changes that we made in the report for this update. And this report we create as an information-rich source. We essentially try to devour as much information as we can come across to feed that into our analytical model, and that includes, of course, qualitative, quantitative, as well as third-party sort of perspectives. That could be associations, could be equity research analysts, could be other credible points that we factor into our iterative process by which we then go through. We evaluate the different inputs and then come up with our consensus view as to what we believe is the forecast for the different markets. So now, on that note, we'll sort of start jumping into a little bit more the meat of the presentation. And as always for these presentations, we start with the macroeconomic perspective. The macroeconomic landscape, of course, drives the economic activity that sort of ultimately shape the construction and cement demand. And so we take that step back, and the sort of main point is that at this point, A lot of markets, we're starting to see that a slightly different, bumpy, uneven 2017, but on net basis, we're seeing an improvement in the macroeconomic world, even though that improvement comes with a significant sort of volatility around the numbers, and it's not really, especially in the capital markets, not really unexpected if we see a big reversal. It's not really a question of if, it's a question of when we will see that happen. And this is, of course, in equities markets visible. And even though equity markets don't really have sort of real world impact, in a risk-off sort of regime, of course, you tend to deteriorate your fixed capital formation, which in some part includes construction and therefore sort of investments that sort of go into the real economy. So there is sort of a, if not a linear linkage, there's definitely some sort of linkage between those two factors. So volatility in the capital markets does make a difference to us to some extent. So what does that mean? Well, it means that our forecast, if there's sort of something major that happens in capital markets still, and this comes also with tax conflicts, and there's a lot of course discussion, as everybody knows now, around tariffs and duties, and what could that do between the different countries and their economies, and therefore sort of sentiment and sort of investments, right? So U.S. duties and European, and what if the U.S. actually enacts a 25% duty on European automobiles? Countries like Germany will be heavily affected and impacted, and that's something that would ripple through with some lag to construction and cement activity. Let's see sort of where that goes, as sort of with many of the policies coming in the White House, it's a little hard to predict exactly what will go where. However, what we can tell a little bit from looking at the different personnel changes that happened sort of last week, even in the U.S., we do see that that there is a shift towards being more hardline, and there's less of a moderating force in the White House to sort of subdue some of these more dramatic changes. So we will probably see a little bit more of a dramatic sort of hardline perspective, stance on a lot of these topics than we've seen before, which is probably not sort of super great for global trade. Whether that's good for the U.S., it's a political topic that we'll leave for a different day. Offsetting this, of course, are tax changes in the U.S., which should definitely stimulate the U.S. economy significantly. And we've also already started seeing other countries maybe offering a little bit more of a tax break, so we have some competition around taxes, which should be stimulative for economies. A little bit concerning though is out of Europe, Draghi being worried about inflation. There's really no inflation in Europe, and this ultimately will lead also to U.S. dollar and euro exchange, maybe rebalancing for the long term. We'll have to see a little bit how that plays out. Yeah, around the rest of the world, China, economic growth they're sort of saying that they're okay with where it is at the moment and how it will evolve. We'll have to sort of see a little bit around that. Of course, now with the President for Life installed in China, then maybe the longer perspective takes an even longer view in that world. We'll have to see a bit what happens there. Brazil, not entirely out of the woods. We have elections coming up. Better than it was, but not great. I think it's sort of the conclusion there. A lot of sub-Sahara is sort of mired in political issues. Continues sort of South Africa economically sort of stalling out, and we have, of course, some of the other countries in the region also facing some challenges as we go forward. India, growth is good, but it's sort of big questions around key policy decisions in the country as we sort of see the economy advancing. We still have some geopolitical risk We'll see a little bit what happens in Asia, and not necessarily even in the worst case scenario if there's a war, but it's a question of being sort of risk appetite in investments and sort of being a little sort of drag on investments, unless that situation is resolved. So we'll see, and we'll also see sort of how things sort of shake out with Russia. Situation doesn't seem to be better, sort of East-West relationship-wise, but that's again something that will have to sort of see how it plays out. But the investment landscape within sort of Russia and CAS is a little cloudy at this moment. So we'll see where that shapes up over the coming months. So if we take all this and sort of summarize what the macroeconomic economists at the IMF are thinking, overall, despite all sort of these question marks and less than ideal perhaps scenarios, the growth is being revised upwards in most of the regions around the world. Notably, sub-Saharan Africa is, as I was mentioning, still facing challenges, and as such is one of the regions where there's been a slight downtick in sort of the outlook. The blue bar is the IMF perspective in sort of January, early part of 2018, and the other bars are from October and April last year, so you can sort of see a little bit what the view was for 2018 GDP growth. Maybe sort of the more surprising, let's say, rates and changes come European and improvement in growth, but it's also not a lot of growth. It's just a slight uptick. So it's sort of the tallest of the midgets, as they call it, but good nonetheless to see sort of an uptick there. And overall, the advanced economies are actually shaping up to do quite well, where we have sort of stagnation in most of the emerging and developing markets. The U.S. growth has been also ticking up. I guess after tax reform was passed, it was a pretty significant 0.4% point revision upwards in U.S. growth. And Chinese growth has been sort of for last year been slightly trending up to sort of 6.6% now, real GDP growth for this year. So a fairly sustainable level, and it's something that the Chinese stores have expressed, comfort with in terms of a new sort of growth target level. Yeah, and so that sort of puts it sort of in a big picture in terms of what we see for the world and sort of how some of the main growth trends look like. Yeah, and on that note, then we'll sort of jump into the global cement markets and take you through some of the specific points there. So on that note, I'll hand it over to Tia, who will take you through some of the observations and highlights from on the cement markets.
Thank you, Robert. So I will start with first I will start explaining how the cement market will behave in 2018, all the change in cement demand across the globe. Later on, we will look into our revisions from our comparing forecast for this year to our previous update, and we will see some main upwards and main downwards revision. After that, we will look into the capacity numbers, and then my colleague Felipe will walk you through a 5-year outlook and as well long-term forecasts until 2050. And finally, we will end up this webinar with some closing remarks. So let's start. Okay. If you take a look to this map, you can get a sense how cement demand will behave in 2018 globally. For this year, we kind of expect this year to be quite positive for the demand, but we're not taking into account China's declines. So globally, we expect the demand to decrease very slightly by around 0.2%. But when you take a look at the map, it is clear that the Chinese market, that is the one that is shading global prospects for the demand in 2018. When we exclude the largest cement consumer, the demand excluding China is expected to be actually growing by almost 4% in 2018. The regions that will lead this growth are Asia ex China, that is also clear on the map, and as well some markets in Africa and Eastern Europe and CIS. We expect also cement demand in Russia to start recovering, starting actually from this year, as macroeconomic environment keeps stabilizing. The demand there is expected to be driven by strong housing construction that was announced in latest government construction plans. In Africa, for example, most of the markets will be coming for quite low 2017 levels. African markets didn't perform very well. Most of them had downward revisions from our previous update. But Nigeria, for example, is expected to recover with very optimistic sentiment for country's construction industry. We expect the Nigerian cement demand to grow by around 8% by the end of this year. And in Egypt, demand did quite poorly last year on the account of kind of troubled macroeconomic environment. There were some currency troubles, lack of confidence of domestic and foreign investor confidence, but nevertheless, the largest consumer in the region will start the recovery path this year. So with more than around $300 billion worth of active projects, we believe that their building sector is kind of on upward trajectory. As well, new investment laws that were passed earlier this year in the country are expected to make business opportunities much easier and to further boost the construction industry there. As I already mentioned, Asian markets are expected to do really well too throughout this year. Worth pointing out are Pakistan and Philippines. They are both projected to experience about 8% year-on-year demand growth through 2018. In Pakistan, domestic sales are expected to remain strong on the back of private and public sector projects. And cement manufacturers are still hoping that mega infrastructure development projects under the corridor, the China-Pakistan economic corridor, will boost the demand. Now, here I would like to mention some outstanding markets in terms of revisions for demand forecast when compared to our previous projections. Global projections for the last year from our previous update, which was last October, it was second half 2017 update. Global demand projections have been revised downwards by 1.5%, which means that our projections were a bit more optimistic, and mostly this decline happened mostly because of quite a decline in China. The same happened in 2018, where our previous anticipations got revised downwards by 2.6%. Besides China, markets that contributed to the downwards demand revisions are also India, South Korea, Tunisia, Kenya, Iran, and some other smaller ones. The slowdown in China's construction of roads and bridges, subways, affected the demand in 2017, and it's set for a kind of harsher slowdown in 2018. That is why our 2018 forecast for Chinese domestic consumption was revised downwards by around 4%. Then in India, demand kind of surprised us and did poorly in 2017. And then as well, we revised our 2018 forecast by 0.5%. But still, we expect that the demand in India will go back to its usual speed due to the upcoming elections and also construction projects that are getting developed in faster pace. And also, since the union budget for housing has been doubled, we expect that the housing projects will give that additional boost to 2018 demand in India. Our outlook for Kenya for this year has been changed on the account of also bad 2017. As I already mentioned, last year for African markets was not the best one. The fuss that was surrounding extended political elections in Kenya really badly affected the overall stability in the country, and as well cement demand has been affected and kept falling throughout the last year. Believing that the country will need some time to go back to its usual growth pace regarding cement demand, we did revise the forecast for Kenya for 2018. We revised it downwards by 3%. Now, on the more positive side, markets that are expected to kind of outperform when compared to previous projections are mostly European ones, which are expected to be following high construction activity levels from 2017. Across the Europe, markets are experiencing accelerating public spending and investments stimulated by very good financing conditions and increasing business confidence. For example, our forecast for Turkey has been upgraded by almost 3% for 2018. Turkish cement manufacturers are very positive when it comes to the demand with developments in the country during 2018. The kind of most important driving force for the cement sector, according to the manufacturers and the Association of Cement, will be infrastructure investments, extensive projects, and urban transformations. Then, on the Middle East, more precisely in Iraq, the government announced that the war is over and that territories has been liberated from the occupation of ISIS. So we believe that these events, even though the conflicts might not be over yet entirely, we believe that these events will set a positive ground for cement demand growth. As such, we upgraded our Iraqi demand forecast by almost 5%. Now, let's take a look at global capacity and make a comparison between global capacity behavior and global capacity behavior excluding China. By the end of this year, we estimate the global capacity to reach roughly 6 billion tons, and it's it's already known, roughly 50% of the global capacity belongs to China. So given that Chinese government announced even more severe measures on capacity eliminations, global numbers are going to remain relatively stable by 2022. It's already wide known, but I'm gonna repeat. Since cement production in China is the biggest polluter among all the industries, last year government and cement association revealed cement industry action plan for capacity, according to which cement manufacturers in the country should focus on capacity reduction and eliminate lower quality cement, grades of cement. But this year, the government set stricter controls on cement sector, which could combine surprise inspections and longitudinal monitoring. We believe that those measures by years will become even more strict. So therefore, Chinese capacity is going down and stabilizing the additions that other regions are adding or are announcing to be added. So when we exclude China, we see those additions amounting to close to 450 million tons until 2022. In our latest capacity forecast, from the previous update of the report, we estimated that the global cement capacity will grow by 0.2% in 2017. While updating this report with the actual numbers, we noticed that our capacity growth forecast for 2017 got revised upwards by almost 1%. And when looking to the revision for the period from 2017 and 2022, our average global capacity growth was also revised upwards by 0.4%, mainly due to newly announced additions in Asia, ex-China region, and Africa. So, saying that, those regions are the ones that will contribute the most with the capacity additions even from this update. Together, two regions are expected to add close to 400 million tons by 2022, which is almost 70% of the total announced additions. Now, to mention some of the most notable capacity additions country-wise from this update, they're gonna happen in India, Indonesia, and Turkey. Those are the countries that also stand as one of our major upward revisions when it comes to capacity, when we compared previous update and this one. More precisely, in India, additions might amount to about 80 million tons until 2022. And following India, other markets that have healthiest growth rates in terms of capacity in the region are also Pakistan and Indonesia, Philippines. But for more details, I would invite you to take deeply look into our report. In Turkey, cement manufacturers are positive. Also, when it comes to the cement demand, therefore they announce capacity increases as well. And on average, the capacity in the country should grow by around 2% until 2022. And now my colleague Felipe will just walk you through a few slides regarding outlook, long-term and 5-year outlook for cement demand.
Hello everyone, and thank you for joining us today. I will now walk you through this slide, which is regarding the 5-year outlook for the various regions. To start, we can look at the elephant in the room, that is China. We expect consumption to fall at a 1.6% CAGR for the next 5 years, This is a downward revision, as Tejas mentioned previously, and it's mostly tied to a slowdown in pacing of construction activity in China. They are currently performing at a very high per capita cement consumption, and while this is while the market in the next years are still going to remain widely active, it won't be able to continue outpacing itself as it had been doing in the previous years. As a result, by 2022, China's global share of cement demand is expected to fall to 51% from 57% in 2017. When it comes to North America, the region will be driven by the US's construction outlook, as it is the largest market. And in the upcoming years, we expect that Trump's 1.5 trillion infrastructure plan will be the main driver for the construction activity. We expect this to be most prevalent in 2018, 2019, and 2020, while in the outer years, we expect that this activity will gradually slow down as investments reach conclusion. In Western Europe, we have noticed an upsurge in demand in 2017, as they have briefly mentioned, and we expect this to conclude and gradually phase out in the upcoming years, recording a positive growth trend until 2022. Out of all markets, I would like to mention that France has witnessed a very positive outcome in 2017, with residential construction boosting demand by 3%. In the following years, it won't be residential demand that will continue to drive growth, but it will be infrastructure projects that are being announced. In Spain, on the other hand, it was one of the highest performers in 2017. The economy had been operating at very low utilization rates and demand was muted, but in 2017 it has shown signs of a strong recovery and it is expected to continue in the upcoming years, although at a smaller rhythm. When it comes to Africa, the unstable environment from 2017 is not expected to continue being like that in 2018, as economies such as one of the largest consumers, Egypt, recovered from their currency fluctuation problem. In 2017, they free floated the currency, which caused high inflation trends and the currency depreciation, and that destabilized the construction market. This has already shown signs of slowing down, with inflation remaining relatively stable, and as a result, for the next 5 years, the country expects to report very positive trends in cement demand. Other big players, such as Algeria and Nigeria, were affected by low oil revenues, which led to lower public investment. In Nigeria's case specifically, urbanization and infrastructure will lead demand in the future, as we expect demand to skyrocket in Nigeria from a very negative year in 2017. Lastly, in Asia ex-China, that will be the fastest pace out of all the regions in the world, where demand will be growing at a 4.7% CAGR for the next 5 years. This is largely tied to positive trends in their largest markets, such as India, Indonesia, and Vietnam. These markets are largely witnessing urbanization and infrastructure trends. But a common issue in the region is overcapacity, as it is currently today, and it's only expected to aggravate in the future. At the moment, capacity additions are increasing at a faster pace than cement demand, which will continue to worsen the situation and pressure prices, particularly in Southeast Asia, as most countries try to get rid of excess production via exports. Now, going to the 2050 forecast. In this section, we are presenting a directional analysis of the cement demand landscape by 2050. Rather than providing a definite answer, we consider the analysis to be more of a point of departure and for further thought exercises. Compared to 2017, global cement consumption under this thought experiment could decline from the current 1.06 billion tons to 3.94 billion tons in 2050. That is a 3% drop. Developed economies and China will likely be the main drivers behind this decline, while underdeveloped economies and emerging economies are expected to experience fast-paced cement demand growth rates for this time period. As a rule of thumb, cement consumption per capita intensifies as countries develop, and once their economies start reaching a mature state, its intensity tends to phase out. As a result, in 30 years' time, economies that are currently emerging and industrializing are likely to stand where China stands today, as you can see in the chart, at the peak of cement consumption per capita. Countries under other states of development are also prone to experience a similar development, jumping one stage ahead of their current position. As a result, underdeveloped and emerging economies logically hold a larger potential for fast and material GDP increase. There is just more to build on a nominal basis to catch up with the standards of more developed nations. Dramatic and continuous growth in GDP, as well as investments in infrastructure and housing, will largely contribute to the expected growth of cement consumption in the coming years. Developed economies, on the other hand, are likely to continue witnessing a decrease in large-scale infrastructural needs, and slower population growth will lead to smaller demand from housing. As a result, per capita consumption could witness a continuous over-time decline in spite of stable growth rates in GDP. In these markets, in the later years, maintenance will gradually play a more important role than that of new construction projects. We'll now go back to Thea. We'll close the webinar with some closing remarks.
Thank you, Philip. And now to conclude our webinar today, I would just like to mention a few remarks to summarize what we talked about today. So most of the countries globally are experiencing synchronized growth in cement demand and in economic output as well. There is an amount of uncertainties coming mostly from geopolitical tensions, and they pose certain risk to the outlook for the demand. As the Chinese cement industry enters a mature stage, it is expected to shrink in following years. But however, global volumes, excluding China, are showing kind of healthy growth, with annual growth by almost 4% through 2022. Capacity-wise, regional leaders are going to be Africa and Asia ex China in the period from 2017 to 2022. And while looking to 2050, we believe that global cement demand will be on declining path. That would be all for today. Shortly after the webinar, presentation and recording will be available on our website. Feel free to download it. And if you have any questions, please do not hesitate to contact us. Also, if you want to purchase our report, feel free to reach to our sales team or to one of our analysts. And thank you and have a nice rest of the day.